Welcome to this explainer. Today we're doing something pretty exciting. We are putting PRA Group, ticker symbol PRAA, through what I like to call the ultimate investment gauntlet. As an investment analyst, I'm going to walk you through testing this company's financials against some of the world's absolute most legendary valuation frameworks. We're going to apply the strict lenses of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside a rigorous discounted cash flow model and some alternative valuation metrics, all based entirely on our financial source data. Let's dive in.
So here is our roadmap for the analysis. We'll start with a quick PRA Group snapshot, apply the Buffett and Lynch lenses, run the Graham checklist, build our DCF analysis, look at those alternative valuation models, and finally synthesize it all into a final verdict.
Okay, part 1, PRA Group snapshot. Let's establish our baseline so we know exactly who this company is and where their financials stand today.
At its core, PRA Group is a specialty finance company. They generate their revenue primarily by purchasing non-performing loan portfolios. So think of it like this. They're essentially buying up consumer debt that other credit originators have just completely given up on or failed to collect. And then they utilize their own global operations to collect on those accounts. It's a pretty fascinating, tough niche in the finance sector.
Looking at the market data from our sources, as of late July 2026, the stock trades at $17.37 with a market cap of roughly $697 million. Now, they're currently riding the momentum of a seriously strong Q1 2026 earnings report, where they posted 73 cents per share, which, by the way, massively beat analyst estimates of 51 cents. So we've got a small-cap financial company with some real recent operational momentum.
Moving right along to part 2, the Buffett and Lynch lenses. It's time to put this company through our first qualitative assessments.
Now, these two legendary investors have very different approaches, right? Buffett, he demands a wide economic moat, highly consistent, predictable earnings, a high return on equity, and crucially, low, manageable debt. Peter Lynch, on the other hand, is a bit more flexible. He categorizes companies, think stalwarts, fast growers, turnarounds, and hunts for favorable price-to-earnings growth ratios, or PEG ratios, as well as strong balance sheets with high quick ratios.
So, let's look at earnings consistency for the Buffett lens. Honestly, it reveals a highly volatile history. While recent quarters show adjusted EPS growth, like that strong $1.46 in Q4 of 2025 and the 73 cents in Q1 of 2026, our sources also highlight a massive $412 million goodwill impairment back in Q3 of 2025. That resulted in a severe GAAP net loss for that quarter, which, as you probably guessed, completely shatters Buffett's golden rule for steady, predictable earning.
But the absolute deal-breaker for Warren Buffett is this glaring metric right here. PRA Group has a debt-to-equity ratio of 4.1288. According to Benzinga's financial health metrics, anything over 2.0 is considered risky. So, this highly leveraged position, which they use to fund their portfolio purchases, would immediately disqualify PRA Group from Buffett's portfolio. And that's even though they actually managed a pretty respectable 11.4% return on equity in Q1 2026.
However, if we shift gears to Peter Lynch's perspective, this looks like a classic turnaround play. Yes, they have high long-term debt, but their short-term liquidity is staggering, almost absurdly so. They have a quick ratio of 23.37. I mean, they are somehow drowning in debt while simultaneously swimming in short-term cash. Plus, if we take the trailing 12 months adjusted EPS of $3.05, it implies a very low PE ratio against that $17.37 stock price. Assuming even standard industry growth to fill our source data gaps, you get an incredibly attractive PEG ratio well under 1.0. Because of that, Lynch would likely view this as a cautious buy.
Let's move to part 3, the Graham checklist. Time to strip away the qualitative narratives and focus purely on quantitative metrics.
The big question is how PRAA stacks up on Benjamin Graham's defensive investor checklist. Well, it passes on adequate size with its $697 million market cap, and as we just mentioned, it absolutely crushes the quick ratio requirement. It also passes the value test with a price-to-book ratio of just 0.66, but it completely fails Graham's strict defensive rules on earning stability because of that Q3 loss. It fails on debt levels, and it fails on dividend payouts simply because it doesn't offer one.
As a strict defensive investor, Graham would probably walk away. However, calculating Graham's famous intrinsic value formula gives us a truly fascinating result. Step 1, we take our Q1 2026 total equity of $1.002 billion and divide it by 38.14 million shares. That gives us a book value per share of $26.28. Step 2, we take our trailing EPS of $3.05. Finally, step 3, we multiply 22.5 by the EPS and the book value, and then take the square root of the whole shebang.
And the math reveals a gram intrinsic value of $42.46. This is incredible, right? It offers a massive margin of safety against the current $17.37 trading price. What this tells us is that while Graham, the strict defensive investor, might pass, Graham, the opportunistic value investor, just might hold his nose on that corporate debt and buy strictly because of this incredibly deep mathematical discount.
Okay, part 4, DCF valuation analysis. Let's move beyond historical data to actually project future intrinsic value.
Because our uploaded sources don't provide explicit management free cash flow projections, we've got to make some educated assumptions to fill in the gaps. We're assuming a 10% weighted average cost of capital, or WACC. We're basing this on the BB Fitch rating mentioned in the sources, which implies a higher cost of debt. We're also assuming a conservative 2% perpetual terminal growth rate and a 5% annual free cash flow growth trajectory over the next 5 years, which aligns pretty nicely with their recent 11% cash collections growth momentum. Running these assumptions through a sensitivity table brilliantly illustrates our range of possibilities. Our base case DCF at a 10% WACC and 2% terminal growth yields a fair value per share of approximately $28.50. And check this out. Even if we really stress test this model with a highly punitive 12% WACC and just 1% terminal growth, the fair value only drops to $22.15. So across almost all reasonable scenarios, the DCF model suggests the stock is fundamentally undervalued today.
Part 5, Alternative Valuation Models. To make absolutely sure our DCF isn't just an isolated outlier, we need to stress test the stock with a few other methods. We're going to contrast a price-to-book reversion model against the average peer comparable value highlighted directly in our Benzinga source data. For the P2B model, we're simply assuming the stock eventually stops trading at a discount and reverts to its actual liquidation book value, which is a 1.0 multiple. The results here are mixed, but super insightful. If PRAA simply reverts to a standard 1.0 price-to-book multiple, it's worth exactly its book value, $26.28 per share. However, the Benzinga comparable average, which weighs it against peers like Green Dot and LendingTree, spots it slightly lower than today's price at $16.36. This suggests that while the company's internal assets are highly valuable, the broader market is currently heavily discounting the entire specialty finance sector. And finally, Part 6, Synthesis and Final Verdict. We've run the complete investment gauntlet, and now it's time to bring it all together for a conclusion.
Synthesizing all of our data paints a really clear picture. 3 out of our 4 quantitative models, the Graham intrinsic value, the DCF base case, and the price-to-book reversion, suggest PRA Group is significantly undervalued at its current $17.37 trading price. Only the peer comparable average suggests it's fairly valued right now.
When we weigh everything out, the core strengths are pretty undeniable. There is a deep quantitative margin of safety, a massive quick ratio of 23.37, and robust recent cash collections growing at 11% as of Q1 2026. But, and this is a big but, you absolutely must weigh those strengths against the glaring risks, an astronomical 4.13 debt-to-equity ratio, and a history of earnings volatility marked by massive impairments.
Blending all these insights together, my conclusion as an analyst is that this is a cautious buy. Warren Buffett? He would definitely pass immediately due to that heavy debt load. But Peter Lynch would likely see a very compelling turnaround story with a great PEG ratio. And Benjamin Graham's quantitative math would absolutely trigger a buy right here, given the massive margin of safety between the $17 market price and the $42 intrinsic value.
So, I want to leave you with this final thought to ponder. Does a mathematically huge 60% discount to Graham's intrinsic value actually justify taking on a heavily leveraged balance sheet? Or is PRA Group just a classic value trap waiting to spring? The decision is ultimately yours. Thanks so much for joining me on this explainer, and keep learning.